Well, the housing market crashes here, but just in a few select cities in the US. And honestly, I was surprised myself when looking at how revealing the data actually is. After we saw massive and unprecedented increases to home values in 2020, 2021, and the first half of 2022, the Fed swooped in and absolutely drove housing demand into the ground by increasing the federal funds rate, which of course impacts and affects the mortgage rates that all of us are receiving. But despite the Fed driving demand into the ground, increasing rates massively, and seemingly every YouTuber on the platform claiming that the real estate bubble and the housing market is bursting, we just haven't seen housing drop like we did in 2008. Now, just to be clear, yes, there is a crash happening in just a few select cities. So let's dive into the data to see what's happening. Now, it's actually really interesting to see how many people are just so surprised that there hasn't been a catastrophic collapse to the housing market yet. People are just expecting today in 2023 to be the same as what it was in 2008, and the situations and circumstances are just entirely different. And now, just as a quick recap for those of you who probably were around in 2008, but maybe weren't following real estate as much. And what we got in 2008 was a double whammy on both sides of the supply equation. Between demand plummeting because people were losing their jobs, we were in a massive recession. And then number two, on the inventory side, we saw massive increases to inventory as people were getting approved for mortgages and loans that they just absolutely should not qualify and could not afford to pay. Topple that with all those other people who just were losing their jobs and they couldn't pay for their homes either, meant that we had this massive group of people who were going into foreclosure in their homes. And so we had tons and tons of homes all across the country hitting the market at the same time that demand was dropping. So this double whammy is really what produced about a 20% decline from peak to trough in the 2008 recession in home values. So 20% was massive, and this was unprecedented. We've never seen a decline of home prices that much ever in the history of the US. So now let's turn to what's happening today in 2023. And let's start with inventory. Really, there just isn't any sort of major shock that's happening to inventory right now. Inventory levels fluctuate as they always do. The housing market is cyclical and seasonal. And so in the summer months, you have more inventory on the market. In the winter months, you have less, as people tend to move in the summer between school or between jobs. And the inventory levels have fluctuated about normal as what you would expect over the past couple of years. And what we haven't seen that we did see in 2008 is that massive increase, that sudden surge in inventory levels when everybody's getting foreclosed on in 2008 that pushed all of those inventory numbers through the roof. And that's not happening today. And in fact, we're seeing the opposite. We're seeing a lot of people pull back from the market. They don't want to list their homes because at the same time you list your home, generally you have to buy another home. And with prices high and mortgage rates really high, people just aren't willing to do that right now. And I think one really important factor that a lot of people are missing here is just the normal life cycle of a person or a family in the United States. Typically, they're going to get into an entry-level home, and over the course of 30, 40, 50, 60 years, a couple might grow, have a couple of kids, and as they're starting to grow, that's the same time their career is developing and they're earning more and more money. And so typically people get into an entry home. A few years later, they purchase a slightly bigger home to fit their growing family. A couple years later, they buy an even bigger home, and so on and so forth. I think on average, most people stay in their home for about 7 years before moving. So what we're not seeing right now is this natural cycle of people upgrading into larger homes, because the larger homes are now just unaffordable. So not only can people not get into these entry-level homes because they're priced out of the market, but the people that are in these entry-level homes couldn't afford to turn around and purchase the same home that they're living in right now because prices are too high and mortgage rates are too high where they literally cannot make that payment. And so forget about them thinking about moving, from a 2-bedroom home to a 3-bedroom home, or a 3-bed to a 4-bed, or whatever it might be. This normal evolution of a homeowner's journey is just not happening right now. All right, I promised you guys we'd get into some data, so let's jump into some data here. So this is from Zillow's December market report, and a couple of key points here that they summarize here at the top. So number one, the typical US home value fell slightly from November to December, so month over month decreased slightly, as high interest rates further discourage home buyers. But US home values on average, again, this is nationwide, are still 8.4% higher than a year ago. So despite six or 7 months of greatly increased mortgage rates, we're still seeing home values that are up nationally over 8%. And the second bullet here, home values were lower than last December in Austin it dropped 4.2%, San Francisco by 2%, Seattle 0.6%, and San Jose by 0.0%. So just a fraction of a percent negative. And again, it's really clear what's happening in those cities. And I have a couple more points of data to get to for you guys on that. But the technology market and what's happening with jobs in those regions are really what's driving this and will continue to drive it lower in the future. Active inventory climbed 15.9%. So we are seeing a rise in inventory, like I mentioned earlier, but we're not seeing a dramatic increase where we're seeing 50, 60, 70, 80% increases, which I think would be necessary for us to really see a nationwide drop or a nationwide housing market collapse. This is why so far it's still isolated just to a few select markets. And then new listings sank 27.8% from last year's flow of newly added listings. And there we have it. There's that counterpoint to why inventory isn't rising. So inventory is rising largely because homes are staying on the market a bit longer because there's just not enough sellers out there. But at the same token, people are just not selling their homes in the first place. They don't want to get into the market right now. They don't want to sell their home as they see the value of it going down. And they just don't want to be in that position where then they have to go buy another home and pay double or triple what they paid before as far as interest rates. Okay, so let's jump back into what's happening in those 4 markets that I mentioned. So Austin, San Francisco, Seattle, and San Jose. So again, those are all massive hotspots for the technology sector. And as we've seen over the past year, we've seen major declines in the value of a lot of these companies. And this is driven by revenues declining and many other factors. But here's the proof, I guess, in the pudding, as you could say. So this is NDXT over the past year. And you can see that we're at a 23.32% decline from the same period from last year. And this is even up a little bit from where we bottomed out here in November. So what's happening here is as recession fears increase, the revenues of these companies are slowly starting to be hurt. And then now that I'm sure many of you have noticed in the news, the result of all this is massive tech layoffs. So let's jump over to some really interesting data on what's happening in layoffs, in terms of layoffs in technology, because I think this is really, really eye-opening. So this is from a website called Layoffs.fyi, and you can see just this year alone in 2023, 174 tech companies have laid off 56,570 employees. And if we turn this to 2022, 1,035 tech companies have laid off almost 160,000 employees, right? So there's a lot of people employed in the US, way more than 100 or 200,000. And so let's put this in context, right? This is a drop in the bucket, but the significance of this is that this is isolated to the technology sector, which are heavily impact those 4 housing market areas because that's where all the technology companies are and that's where they hire people. So just to give you a little bit more context on what's happening too. So starting in January 2022, the pink is employees laid off, blue is companies with layoffs, and you can just see this steady increase and rise to where November, December, January, we're seeing 50,000+ people laid off. Even already in January, we're almost at 60,000, and we still have another week and a half left to go. And tech layoffs since COVID, so similar chart here, except this is by quarter. You can see big layoffs in Q2, so this is right during March and April, of course, the peak of the pandemic, and then drop to almost nothing as the housing or as the employment market was just booming. This was the Great Resignation time period, right? I'm sure many of you are familiar with that. And then as we get into Q2 and Q3 of last year, that's when a lot of these companies are seeing the values of their stocks drop, revenues are falling, and so they start restructuring. And And that's where we get to all of these massive layoffs happening. And these are likely to continue over the next couple months since we're in a recession and we're probably going to be in one for a little while. This chart here is really great at just making that point extra clear that Seattle, San Francisco are the primary areas that are hit, right? So this is all the companies that are laying off and then the number of employees and their locations, right? So the top, what is this? The top 6 are all between Seattle and the Bay Area. You have some Amsterdam, but then rounding out the top 10 are more San Francisco companies. And if you just keep scrolling down through this, you have a couple others thrown in, a couple New Yorks, Chicago's, but still you have Uber making massive layoffs. You have Zillow, Airbnb, Instacart. All of these companies are laying off people all over the place. And more you scroll through this, you can just, it's blatantly obvious how many here are tied to the Bay Area. So, and a lot of this is relatively recently, right? So these people who were just laid off in November, December, January, they're getting 3, 4, 5 months severance packages. And so I don't think the true impact is really being felt yet, but if you just give it a couple of months, a lot of these people are going to be in really challenging spots because it's challenging to find a job in the tech industry right now. And so some of the ones that are looking will definitely find jobs, but a lot of those people are just not going to find jobs. So what are they going to do? They're either going to sell their house and move somewhere entirely new, or sell their house and become a renter in the local area just because they can't afford their housing payment, or they might move in with family or with friends. And so I think over the next 6 to 8 months, we're going to see this start to play out in the data, and the housing crash is going to get much worse in those areas because the tech industry is definitely not through it yet. It's going to continue to get worse. We're going to continue to see more layoffs, and those layoffs will result in people moving and selling their homes as prices continue to decline, and they're going to throw a lot more inventory on the market. Again, it's relative, right? It's not crazy amounts of people. It's not millions or tens of millions, but it is going to be significant in those specific areas. All right, guys, that wraps it up. I hope you enjoyed it. Let me know what you thought of the video. Let me know if you have any questions. Happy to answer any sort of questions that you guys have down in the comments below. And make sure you hit the like button for me. And if you haven't subscribed and you liked what you saw and want to see more, make sure you subscribe so you don't miss more in the future. All right, thank you guys, and I'll see you in the next one.